All right. Oops, there's some echo. Hang on. Okay. Can everybody hear me? I'm hoping the answer is yes now. Sorry, I don't know why. I couldn't open Zoom correctly on anything. Jeez. Sorry about that. Cool. Okay. Sorry again about that. God, it's like every week something. Okay. Let me send out one more message letting everybody know we're getting started and let's get right into it. Sorry to keep you guys waiting, everybody. My apologies. I'm not going to waste any more time. Let's get right into it. So tonight is going to be class number 6 of the beginner's course series. I'm going to pull up the PowerPoint, just remind everybody where we're at. So course number 6, we're going to be talking about indicators today. So I'll say it's going to be a bit of a step down in complexity from our last lecture. Last lecture, price action and volume, we kind of increased the complexity a little bit and worked on some more kind of technically difficult concepts. Like I said, today we're going to kind of bring it down a little bit of a notch and talk about something a bit simpler, which is basically just indicators. So at a high level, I think a lot of you are probably familiar with what indicators are. So I don't think this is going to be anything too new. But yeah, any questions? Cool. All right, let's get going. Again, just to recap, we're about halfway through the beginner's course series. I'm not sure if you guys have noticed, but attendance has definitely dropped. So we'll probably try and find some new ways to get the people who are a little less dedicated to get back in here and make sure we're encouraging the education. But for now, it's good to see all you guys, and thanks for making the time for us tonight. We got 6 more lectures after tonight, so we're just at that halfway point. Yeah, again, I want to ask the question, but I think I know the answer. How many of you haven't been to one of these beginners course series lectures before? Is this anybody's first time in one of these classes with me tonight? With all of us tonight, I should say. So far, it's looking like no first timers, which is definitely a positive thing. It means we've got some dedicated people. Let's get it. Okay, yeah, so I don't need to basically give you guys any remarks before we begin. I think you guys all know how these lectures operate by now, so let's start working on this. So the first section is a quick discussion on how to actually set up indicators. Okay, and I didn't think I had any slides on that. So we're going to talk a little bit about setting up indicators in Thinkorswim, because this is a platform that I typically use for my own charting. Just because I use it doesn't mean that you have to. And kind of like we talked about in other lectures, when we set up these charts, it's going to look maybe a bit different on other platforms, but the fundamental concepts are the same. So we'll talk just very quickly about how to get a nice set of indicators going for yourself. And then we'll talk a little bit. Well, actually, I'll even take a step back. I don't know why I didn't have this in the PowerPoint, but let's just take a quick kind of step back and talk a little bit about what indicators actually are. So fundamentally, indicators are basically supplemental kind of calculations that you could add to your charts. So obviously by default, as you guys can see on my screen here, we have our most kind of simple indicators, I guess you could say, price and volume. And some people call either one of these an indicator, but I mean, this is really just the real-time price data. So I don't really fall into the same group, but some people might call volume an indicator. But anyway, every chart starts with kind of your fundamentals, price and volume. Indicators are really calculations based on what's going on with the price and volume of that chart. And you can expand the scope of indicators. So you can have some indicators that look at the overall breadth of maybe a given exchange. You can have indicators that look at maybe the net change in options volume in a specific contract or expiration. So there's a lot that you can do with indicators. Today, we'll keep it mostly pretty simple and talk about some more basic applications, but there's definitely a lot that you can do with indicators, and I'll just give you guys a quick kind of high level into that before I talk to you about how to actually add them. So we have kind of one example of a set of indicators here where we have our volume profile on the left and some moving averages here on the plot. Here's another example where we have kind of some information, some lower plots on breadth, market breadth. So this shows the number of names advancing versus declining. This shows the number of new highs and new lows, or excuse me, net highs and net lows in the market, which you can see right now is kind of just stumbling right around the 0 line. No big thrust in either direction at this point. You can kind of see what that's corresponded to in the past. Another couple examples, you can have some more complex studies. This is an old one from Assassin that has a bunch going on. It's something that I never use, but I just kind of keep because it does look cool. Yeah, anyway, there's a lot that you can do with indicators. There's so many different combinations. I think the most important thing to note, though, is that indicators in general aren't meant to supplement or aren't meant to replace price or volume, right? So you shouldn't ever be using indicators simply on their own. It's basically in the name, right? All it does is indicate things. It doesn't say anything that's certain. It could just be another kind of extra reason why you think a trade may go one way or another. So important to note, just like we talked about in candlesticks and support and resistance, it's important to use all these kind of more fundamental concepts that we talk about in conjunction with each other. So you should never just be looking at indicators. You should never just be looking at price or you should never just be looking at levels. It's always good to look at some of these things in combination. Okay, so talking about just adding indicators to your charts, very basically, in Thinkorswim, what you can do is navigate to the Studies tab up here, go into Edit Studies, and here you see a massive list of all the studies that you have available to you. The cool thing about Thinkorswim is there's a massive library of kind of user-generated studies. You can really easily code your own stuff. So this is something from Joe, and if I go in and edit, we can see what's going on in here. So who knows where he got this from? Okay, compiled by Joe named Joe. So anyway, you can see that there's a lot of flexibility, at least in Thinkorswim, so you can kind of do your own thing, which is pretty cool. Okay, so adding a study is basically as simple as searching it up. So simple moving average is one thing that I'll search up, clicking it, adding it here, and all of a sudden we have our first indicator shown on the chart. So let's say, for example, we want to customize that indicator a little bit. We can go back into the Edit Studies window, click this gear icon, and from here we can start to customize a little bit more about how this actually looks. So here we can customize the color. Let's say we don't want it to be blue and we want it to be red. Let's say we don't want it to be a straight line and we want it to be dots. And let's say we want it to be a little bit more prominent, so we increase the width. Then when we apply that, we now have a moving average with red dots that are a little bit bigger. That basically is now kind of custom configured to the way we want it. Moving averages in specific, there's a little bit more config options than just things like visual. So here you could change the length of the moving average, which we'll talk a little bit more about what that actually represents, probably within the next couple slides once we get back to the PowerPoint. But this is basically how to add a single indicator on a chart. Now, a lot of you may notice when you look at other people's charts, whether it's mine or maybe Flips's, you'll notice that usually there's more than kind of one indicator on the chart at a time. At least in specific, some things that might come to mind is maybe a couple of moving averages that you might see on a chart at a given time period, which this is a study that I think I copied off Flips a long time ago, and so is this one. I don't even remember what these all were, but something that I guess I just took from Flips at some point. So you might want to have kind of a repeatable set of studies that you can just load very quickly, and they have all the kind of configuration options that you're looking for, that sort of thing. So the way to do that is you would go into your studies, edit studies, and add all the different indicators that you would like to have. So in this case, we have a couple different simple moving averages and this custom little chart label thing up at the top left. And then from there, you could customize these however you want. So you could set all the colors, set all the width, however you want them to display. And then once you have the indicators looking the way you want them to, and they're configured in a way that you think is going to be useful for the future, you could go into the study section and click Save Study Set. And this will basically allow you to name a set of studies where every time you click on it and load it, it is going to automatically load up that set of studies. So if I remove everything and then click that 20, 50, 200 set, it just automatically brings everything right back. So that is definitely a super useful feature. And I think it's something that a lot of charting softwares offer. So not something super unique to Thinkorswim, but definitely an important feature that if you're planning on using indicators in any of your charts, it's definitely going to be one that you want to take advantage of. And you can see for me personally, I have a decent amount of studies that I like to kind of flip between if I can. I try my best to keep this clean and not have study sets saved that I just am never going to use anymore. So I have, the 5 and 13 EMAs just pre-saved, ready to go. The 9 and 21 pre-saved, ready to go. The 20, 50, and 200 just ready to go. the 10 and 20 EMA cloud, 10, 20 EMA cloud with the 50 simple and 200 simple. So I have a lot of studies that I basically use on a regular basis, or studies that I've kind of seen other analysts or other traders use that I've kind of wanted to save, maybe not necessarily to use it immediately, but just kind of to have for future reference, right? If I ever want to go back to it and see, maybe what they're looking at, I can kind of pull up their study set and look at the chart through their lens. So a little bit of a different perspective. But that's basically how to add and customize indicators on the chart. I don't want to go too in depth on that, only because different brokerages it's going to work differently. But the concept should apply across most softwares. So any questions or comments with that before we keep rolling? Talk a little bit about what these indicators actually mean. Everybody doing okay so far? Awesome. Yeah, definitely a little bit more of a boring part of the lecture for sure. So apologies for that. Yeah, Stephen, go over the difference between SMA and EMA. That is absolutely something that we will cover. And I think that's probably, okay, that will come up in probably 10 to 20 minutes, Stephen. So if you can sit tight with me, we will 100% get there, just kind of as part of the natural progression of the lecture. So we'll get to that one. Okay, so the way I kind of present these different types of indicators, I've divided them up into two separate sections. The first section that we talk about is going to be what I call oscillators, and hopefully it'll be pretty clear why they're called that. And the second kind of subset of indicators that we're going to talk about are going to be referred to as moving indicators. And just to kind of explain what those terms mean, oscillators are basically going to be indicators that show up below the price chart. So these indicators down here are excellent examples of oscillators, right? They show up below the price chart. And as a result, yeah, that's it. They show up below the price chart and they can oscillate, but I don't know. I don't think it's a real technical name, but for the purposes of this lecture, we'll call them oscillator. And the other kind of term that I'll use throughout this lecture is going to be moving indicators. Moving indicators are going to be moving averages that show up with, or not moving averages, but indicators that show up kind of in line with price. So that could be moving averages, that could be VWAP, it could be the Bollinger Bands, anything that kind of moves around as price moves. Those are going to be our moving indicators. So both those terms will probably continue to make more sense as we move throughout the lecture, but I wanted to just kind of warn you that that's coming before we get into it. So the first oscillator that I wanted to cover is one that probably everybody has heard of, and it's called the MACD, which stands for Moving Average Convergence Divergence. The one thing that I want to note about this indicator and basically all other indicators is they are a lagging set of information, right? Fundamentally, indicators, for the most part, are based off of prior action in price. So the MACD is made up of a couple moving averages, which we'll talk about. Moving averages are made up of a couple days of data at minimum, right? At least two. And as a result, right, moving averages are not going to be leading indicators. So they're going to be very difficult to necessarily directly indicate, or I should say, it's going to be very difficult to use indicators in general to indicate future movements in price, but rather it helps you better understand the trend and potential reversals and that sort of thing. But really, all indicators are lagging. So they're not going to be great kind of windows into what price might do in the future. Price and volume are going to be your most real-time indicators, right? Price and volume are coming through in the moment, right? There's no lag to it. So talking about the MACD, it's a very basic indicator that helps determine overall momentum in the market. I'll say me personally, this isn't one that I use on a frequent basis or really at all these days. I personally prefer to use just the moving averages on the chart to make this same determination. But it's one that a decent amount of people use and it's super popular. So we got to at least talk about it. Basically, the way this works is you're supposed to be looking for crosses to the upside and downside for kind of a buy or sell signal. So here is an example of a cross to the upside, where this blue line here crosses above this, I don't know, brown or yellow line. You can see this histogram behind the chart turns green, indicating positive momentum. And this is where you would expect to see kind of a longer term reversal in price. And similarly, you should be looking for crosses to the downside for a potential reversal signal. So you can see here the blue line crossed below the brown line. We have a red histogram at the bottom of the chart indicating negative momentum. And you can see we had a bit of a downturn after that cross to the downside. The last thing that you can look for in the MACD is convergence and divergence, which can indicate strength of the overall trend. So you can see here, oh, that's not exactly what I thought it was going to be. But anyway, oh, okay. Sorry, I can't remember my own lecture. This is basically talking about these two moving averages converging or diverging with each other. So as these two lines get further apart from each other, that basically represents increasing momentum. And as these two lines get closer to each other, that represents decreasing momentum. And the other thing that I wanted to cover with the MACD is not something that I captured in this PowerPoint. So I'll just show you guys here. So let's just go ahead and add it to our chart, which we already have it. We'll remove our other studies. Cool. So the other thing that people typically like to look for in the MACD is a larger divergence. And what that might look like is, for example, here at this point, we made a higher high. So at this here, price topped out around 607. Here, price topped out around 610, right? So we made a higher high in price. However, the MACD actually made a lower high, right? So this is kind of another indication of potential weakening momentum, is seeing this potential bearish divergence in the MACD. Now, again, it's just an indicator, right? It's not something to just go look for and bet the farm short or long or whatever it might be, but just things to be mindful of. And if we take a look and kind of review recent price action in the S&P, so screenshots were a bit dated. Let's just mark out some of the more recent MACD crosses. So here is going to be one. Here we'll say it's kind of all one, and here. And if we relate those to price, we got to cross here. We got to cross here. We got to cross kind of all over the place here, kind of nothing happening. Got to cross there. And another one right about there. So you can kind of see how these crosses in MACD definitely lag the overall trend change in the market. And that's something normal that you'll see with a lot of indicators, right? They're not going to be, leading indications of when the market's going to reverse. It's mostly going to be confirmation of the trend that's already taking place, or an indication of kind of continued momentum in that direction. So you can see here, after that MACD crossed, we got a decent continued move to the upside. After the MACD crossed down here, we got a decent move lower, about 2%. Here, the MACD crossed to the downside, and we basically got no move lower, so you would have got wrecked on that move if you just went short blindly there. Here, the MACD crossed higher, you got a decent move to the upside. Here, we got a lower cross, nice move lower. Here, upside cross on this day, small move higher. So fundamentally, if you went long and went short every time the MACD crossed, you wouldn't be doing too poorly for yourself. But it's definitely not kind of the end all be all for traders, right? It's something that you could use as a tool. But yeah, anyway. Steve, an interesting question. Does it work well on the smaller time frames? Let's take a look. That's actually not a question I've even answered for myself in recent history. So let's see what it's been looking like. So we'll take a look at the S&P just from today. Small sample size for sure. Oops. And let's see what our MACD is looking like here. So I'll make both these nice and big so everybody can see. Okay, so we got a cross basically minutes before market open, like right here is where the cross happened. So we'll just say at the top of this bull bar, we got a MACD cross. If you went long at the top of that bull bar with same days, you probably wouldn't have done too well. For a while, you would have had to know to continue holding. You would have been really wrecked right here. You probably would have seen profit right there. But ultimately, after that cross, nice move higher until the cross to the downside, which was here. So this point, we got across to the downside, nice move lower from there. Here, we got across to the upside. It looks like basically here is when we officially crossed up. And then for the rest of the day, we didn't cross back to the downside until right about there. So overall, if you bought when you cross to the upside today, you would have gotten, let's see, that's about $1 there and another 82 cents there. And if you sold when we crossed to the downside, you would have basically been break even there from a dollars perspective. And if you sold after hours or right here, you would be also basically break even. So the answer is, I think, at least based on this day, it works decent, right? It's not anything to really write home about. We can look at this day when there was a bit more of a significant move. It looks like here is when that MACD crossed to the downside. And then right about here is where we cross back to the upside. And here is where we cross back lower, kind of a fake out here. So this day looks a little bit more brutal, right? You would have kind of sold here. You would have made about $2 there, but then you would have bought here. You would have lost money there. Then you would have sold here. You probably would have ended up losing money there. You would have got chopped up a little bit during this period. So again, the MACD is not really my favorite indicator, but I feel like I'd be doing you guys a disservice without telling you about it, kind of giving you the introduction to how it actually works. The last thing that I'll kind of introduce you to is the idea of kind of monitoring that divergence as we get close, or the convergence as we get close to the points of crossing. So like, again, as kind of the PowerPoint showed, once you see this histogram begin to decrease in size and magnitude, that's when you want to be a little bit more concerned for potential reversal. And similarly goes for kind of these upside bars as well. Once you start to see the momentum drop off in that histogram, you want to be looking out for a potential reversal. But again, I can't stress enough, MACD, it's something that you certainly could use in this way. It's not something that really I personally use like this or really at all, but I gotta at least introduce to you that it exists. Any other questions on that one? That was a good question, Stephen. Very good question. Cool. All right, let's keep rolling. Oops. Okay, the next one, once we get through all these animations, is going to be the RSI, also known as Relative Strength Index. This one, again, is going to be a plot that's shown below the chart. And there's kind of two areas to pay attention to. The first one is kind of what's called an overbought condition. And this occurs when the RSI reaches above this 70 level. The one thing that I didn't mention on MACD that I just realized is how it's calculated. The MACD is basically calculated on two simple moving averages, or in this case, exponential. So it's using I believe 12 and 26 EMAs to calculate these lines. The calculation of the RSI is definitely a bit more complicated. It's a more detailed equation. I actually don't know how this one's calculated off the top of my head. But again, these overbought conditions typically indicate potential overextension to the upside. Now, one of the most common misconceptions that I want to really highlight is that a move above 70 means you need to sell, and a move below 30, which is going to be the oversold condition, means buy. Something that's overbought can stay overbought, and something that's oversold can stay oversold. So just because something is overbought or oversold on the RSI does not mean that you should just go and start buying or selling stuff. That is typically not going to be a good idea. When something holds over that 70 line for an extended amount of time, that could have a real indication of strength. And similarly, when something holds below 30 for a good amount of time, that could indicate serious weakness. Some potential good examples of that, let's see, Celsius might be a decent one. Let's check the RSI on this guy. RSI. Okay, yeah, this is a decent example. So if you look at the RSI, all throughout this period, and I'll even go on the weekly. Let's see what the weekly looks like. Not as good of an example as a daily. We'll focus on daily. Okay, so focusing on the daily here, if you'll notice here, RSI was oversold for basically 4 or 5 days, right? And some people might be saying, okay, well, it's oversold, it's cheap, it's time to buy. Okay, well, if you buy the first day it's oversold here, look where price is at now. And then again, we end up right back at this oversold condition. Basically, for this whole period, we're oversold with no significant bounce. Here, again, we're oversold. Here, we're oversold. Here, we're oversold. And the selling continues to take place. So this is just a reminder that price action is always king, right? Just because your indicator might be telling you that something is a buy, you have to be paying attention to price action. And if you're trying to buy something that just hit new lows, right? Just broke below this swing low. Sure, okay, maybe you could try that first buy right below that swing low. But once you start to see continued daily closes where we can't make it back above that spot, you should start to be a little bit more concerned. And then again, right, we continue to set new lower highs, break below our prior lows and hold below those levels. That should be a damn good reason that it might not be the time to be investing in this given name, right? And again, we see the same concept. Here, again, we were oversold. Big period of oversold, right? Put in kind of a floor right there. After that oversold condition, we break down again from that level. We can't reclaim it. So bit of a warning there. And another interesting example should be Tesla. Tesla's a great one. Even if we look back, I think 2021 was when this condition got most excessive. So let's take a look at this. Yeah, okay, my memory serves me well. Okay, so Tesla here, when it went on one of its most kind of aggressive rallies to prior all-time highs back up in the 400s, it became oversold once it broke this $270 level. It continued to be oversold for another 50% rally, right? I'm sure we'll see something similar on NVIDIA. Yep, NVIDIA became oversold at $50 here. It remained oversold all the way until it hit here for a 27% rally, but basically it remained oversold all the way until here for an 80% rally. Same thing here. It became oversold on this day, rallied 40%, or sorry, overbought. MSTR, I'm assuming, is another big one. This one's a bit more parabolic, but here it became overbought, rallied another 100% before it actually put in some kind of meaningful reversal. So I can't stress enough, especially these kind of oscillator indicators, you really got to take them with a grain of salt, right? You have to remember price action is always going to be king. If price action is telling you one thing and your indicators are telling another, you first have to trust that price action, right? Because the price action, as we discussed in our lecture last week, is always going to tell you what is going on under the hood, right? It gives you that window into what buyers and sellers are doing at any given moment in the marketplace, which is something that most indicators can't really do. Now, again, I mentioned earlier, there's some indicators that are pretty cool and they can look into options volume. A lot of those are proprietary or you have to pay for them, but still, there's 100% indicators that provide you really valuable real-time information. But a decent chunk of them are lagging, and you do need to understand that before you start trying to use indicators, because you will 100% get burned trying to buy and sell on every single one of these signals that you think means something, but actually might not matter as much as you think it does. Okay, that is basically RSI. The only other thing to be looking for is potential divergences. So similar to the MACD, there is kind of those bullish or bearish divergences to be looking out for. So just talking about that really quickly, here's an example of a bullish divergence. So when price action makes a lower low, when the RSI makes a higher low, that's going to be a bullish divergence. And yes, Jonathan, we will review that. I think that one's next. It is next, actually, I can see it. So this is going to be an example of a bullish divergence. So basically what the relative strength line is telling us is that the strength of the stock has increased, but the price has decreased. So under the hood, whatever calculation the RSI is doing, like I said, I don't know off the top of my head, but basically it's telling us that the strength of the stock has increased, which is a bullish divergence, right? That would be a bullish signal. Oops. And a bearish divergence would be the opposite. And let's see if we could find one probably recently. Again, on the SPY might work. Yeah, this is good. So this would be a bearish divergence, right? Or something that could be considered a bearish divergence. And this is a more long-term one. Where here you could see back in this time, oops, let me zoom in, make it more clear. Much better. Here, all the way back in July, we hit an RSI of about 80 on the SPY, right here. Since that time, we have only made lower highs in the RSI, while the SPY has increased 7%. So this is going to be an example of a long-term bearish divergence, right? So this is not something that you would want to see if you're, really focused on the RSI. But again, price action is king, right? Just because this bearish divergence is taking place doesn't mean the market's going to break down, right? If you were looking for the market to break down, you'd probably first want to see this longer term trend break. You'd probably want to see us break from the shorter term uptrend as well, like that, before you really start to say, okay, this bearish divergence might actually be playing out now. Cool. All right, that's the RSI though. It's a pretty simple one. Cool. All right, let's keep moving. Next one is going to be the TTM squeeze. So TTM squeeze, a little bit more complicated. There's a few more colors and things going on here. Basically, the first thing that you need to know is red dots in the center here indicate a squeeze, or also known as consolidation, right? So once you start to see those red dots, that should be a sign to you that price is definitely beginning to consolidate in a tight range. And I know this is something that Flips uses on a relatively frequent basis. Again, personally, not something that I keep in my wheelhouse on a super regular basis, but I know it's popular with him. So in terms of the specific things that he looks for, I won't be able to answer those questions. But in general, right, the things to be paying attention to are these red dots, which indicate a squeeze, and then also this oscillator, which is similar to MACD, and the oscillator indicates the strength and direction of the trend. So, for example, when you see these light blue bars, that basically means that the strength is increasing to the upside. When you see the darker blue bars, that means strength is still to the upside, however, it's beginning to wane. And then same thing for the downside bars. When you see these dark red bars, that means strength is increasing to the downside. And those yellow bars mean that the trend is weakening to the downside. And generally speaking, the place to get involved, when you're using the TTM squeeze is once that red dot begins to change to green. The term for that is basically the squeeze is firing, or one thing that Flip says is squeeze, release, open, or something like that. So that's basically what he's referring to, is when those red dots begin to turn green. That basically means that the period of consolidation is now ending, and you should begin to expect a trend moving forward. So let's just take a quick look at that really quick, TTM squeeze. I don't know if I have that set up anywhere. Perfect. Cool. So we'll go into the 5-minute real quick and just see what this looked like today. So if you were trading the TTM squeeze today, it looks like basically you had none of those periods of consolidation at all. Ooh, okay, decent one. Let me remove these other moving indicators. Clean it up a bit. Okay, so if you're trading TTM squeeze today on the SPY, the only period where you got that kind of squeeze was right here, basically, which it actually didn't turn green until the close of this bar. So this actually would have been that would have been a very bad trade based on this indicator alone. So the squeeze released on the close of this bar, which was basically right at the highs. So you would be longing directly into the highs based on this indicator. So that would not be very good. Let's look at another day and see if there's any better examples. Here we had a single bar squeeze on the 5-minute, and it released here. So that would be a decent trade, I guess. Still not great. I'm sure this day was decent. Here we had a squeeze, and it released right here. Wow, I have not back tested this in a long time, but this is actually awful. So this is when the squeeze released here, and that is the dead top. Here is another squeeze release. It looks like it's to the downside. That would have been a very slow and painful trade. Here, the squeeze release, and it was telling you to get long, which kind of would have worked until it didn't. So I guess point being, the TTM squeeze really isn't for me. Personally, this is, I think, the indicator that I find the least useful. And the reason being is all it's telling you is indicating when price is consolidating and when it's not, which in my opinion, you really don't need an indicator to do that. Like if you're trying to see if price is consolidating, draw some kind of trend. And once we break out of that trend, that's when you know that the consolidation is over. Or if you're looking at a key level, right, previous day's high or pre-market high, basically if we're trading within pre-market high and pre-market low, we're consolidating, not going anywhere. It's a consolidation. And similarly, right, you could do the same thing for different kind of patterns. So here, or maybe even an uptrend. So here, for example, if we broke below this uptrend like we did right here, maybe this consolidation is over. You could even draw some kind of pattern like this little horizontal line. Yeah. Anyway, long story short, the TTM squeeze I just don't personally like it, and it makes me hard to justify too much of the use case. I don't know if Flips has like configured it in a way to make it more useful for him, or if he just uses the native TTM squeeze. But if he's just using the default settings, it definitely hasn't been doing too well on the SPY recently. Yeah, Skylar, we still have a couple indicators to get to, but we could probably handle that question towards the end. It's a good question. All right, the last one that I want to cover is the Stokes slow. This is one that you'll see Tilio use more often. It's very similar to kind of how to read the MACD. It's kind of like a combination between the MACD and the RSI. So the way this one works is you want to look for the crosses to the upside or downside. So here is going to be a cross to the upside. Here is going to be a cross to the downside. So crosses to the upside generally are going to represent a potential move to the upside, and a cross lower when the red line crosses below the pink is generally going to represent a potential move lower. Now, the other thing with the Stokes slow is that it also has those oversold and overbought zones. So the oversold is when the lines get below that 20 level at the bottom there, and the overbought is when those lines get above that 80 level at the top. So there's a couple ways you could use it, right? You could use it basically as a combination of the RSI and MACD, where RSI, a hold above 80 could either be a sell signal or an indication of strength. And similarly for the RSI below 20, or in this case, Stokes slow below 20. And then same idea for the, what's it called? The crosses. Cool. In the interest of time, I probably won't talk too much more about it, but in my opinion, this one's a reasonably simple concept, and I really want to get to the moving indicators section, because in my opinion, these are going to be my favorite indicators to use and my personal kind of most valuable indicators. But not everybody will agree, and that's okay. All right, so I have a quiz question. I'll probably just blow by. Oh, well, the quiz question isn't even working. Anyway, yeah, I want to blow by the quiz question because for some reason it's already gotten super late. I don't know how. But let's talk a little bit about moving averages. So moving averages are, in my opinion, should be the backbone of anybody's indicator setup. This is my own opinion. But the reason that moving averages are so important is for at least the longer term moving averages, these represent typically a good value buy area. And I'll just show how real this scenario is. If we pull up our 20 and 50, 200 moving averages and take a look at something like NVIDIA, take a look at NVIDIA. You'll notice over the last couple years, NVIDIA hasn't made too many trips to the 200 moving average. But when it's in an uptrend, generally speaking, those trips to the 200 moving average are going to be buys for these institutions. And you can see here, it was a bit choppy, but ultimately we are now up. I'll just say from our first touch to the 200 moving average, which was right here, we're up 10%, which is a big return in basically 2 weeks. So the 200 moving average is a very, very important level in general for everybody in the marketplace. Generally speaking, nothing good happens below the 200 moving average. And I can show you that example when we broke or got close to breaking the 200 on the S&P originally. And you can kind of zoom in a little bit on this here. When we first kind of tagged the 200 moving average at the start of the bear market in 2022, we got a decent bounce higher. So if you bought that first touch there, you would have gotten a modest 3% return. And then you'll notice kind of the choppiness around that 200. And once that 200 moving average really acted as resistance, right, we had this kind of rising volume day and rejection off that 200. We really never looked back. And this resulted in multiple tags of that 200 as resistance. And ultimately, once we really started to hold below that 200 moving average, about a 100-point decline in the indexes, which is pretty significant. And you'll notice the bear market really started to end once we started to make progress above that 200 moving average, right? So if you bought that first break back above the 200 moving average, maybe you would have gotten faked out a little bit here, but if you continue to buy those breaks above the 200 moving average, you would have gotten basically a 7% return until you sold here. And then again, if you were continuing to hold on to that same strategy, you should have rebought on this day, which obviously would have resulted in a massive return at this point. So long story short is that there are some moving averages that provide a significant amount of value to institutions and traders alike, right? Those moving averages represent really nice long-term buy zones. The other thing that I really like about moving averages is they make a very clear representation of trend. And I want to just pull up this back test that I did years ago now, but I still find it's very relevant. So let me just take a look and see if I could find it really quick because I didn't pull it up before. Oh, cool. Let's see. Okay, so this was a back test that I ran all the way back in, let's see, March of 2023. So generally speaking, the kind of summary of my sentiment was being much more bullish than bearish at the current moment. And the big reason why was the result of this specific back test. And basically what's going on here is a script or study that I ran that buys the S&P 500 every time the weekly 200 simple moving average closes above the weekly simple. And it'll exit when the 20 is less than the 50 and the 20 is less than the 200. So basically we're in a full downtrend. And what you can see here in this study is that specific condition had happened 4 times over the past 30 years. Over the last 30 years, the profit of this specific strategy returned about 1,100%, where if you just bought and hold the asset, you would have made about 788%. Every single one of these signals was successful. Every single one of these signals was a win, with the average win being a 170% winner. And the interesting part about this specific moment in time was that this was the first week where we got that 20 moving average back above the 50. So that was that first kind of signal to show us that, hey, this bottom might be in. And this was in March of 2023. So go all the way back here. This, let me see if we can pair it up. This was the weekly, sorry, wrong time frame. This was, let me zoom out even a little bit more so we get the full picture. This image was posted, God, I can't get my story straight here. This image was posted right about here, right when we started to get to an inflection point, right? That 20 simple started to move back above that 50 simple. And you guys can see this is where we never looked back. Once this 50 simple moving average crossed back below the 20, we have now returned 52% in 2 years, which is massive, right? Massive return. Long story short, these moving averages are incredibly, incredibly powerful, especially when you're paying attention to these sorts of things on the higher time frames. So long story short, moving averages, great way to manage your risk on the higher time frames. Also a great way to determine high quality entries and exits on your positions. So it's something that I love to pay attention to and couldn't recommend it anymore for you guys to start paying attention to as well. Once we start dipping to these longer term moving averages on the weekly, they basically always end up being a good buy point. Like, for example, every move back to the 20 weekly has been a great buy so far. Any move back to the 20 weekly has been a great buy. Any move back to the 200 weekly has been a great buy, and also the bottom, dead bottom of the bear market, right at the 200 weekly. And you can see once this 20 weekly crossed below the 50, we never set a new high again until that 20 crossed back above. And just to show you guys a real world example, because I feel like you got to see it, let's go all the way back to 08. Same story here, right? When the 20 is over the 50, over the 200, we're cruising. We got a great uptrend. Once that 20 gets below the 50, you really got to start being cautious, right? Once this cross below happened, price dropped, let's see, 50% in a little over a year. Really shocking stuff. So I can't stress this enough. Moving averages are super important to get a pulse check on the trend of the market, as well as just very, very high quality support and resistance levels. And we'll talk a little bit more about integrating the moving averages into our trading strategy in future lectures, but this really is a good opportunity for me to stress kind of why they matter. The last thing that I want to mention is how they're calculated. For the most part, it's in the name, right? Simple moving average. It's calculated very simply. So if the period of the moving average is 20, which is what it is when you hear me say 20 moving average, or if the period is 50 moving average, the period is 50. Basically what it's doing is it's adding the closing price of a given stock over the last 20 days and dividing it by 20. It's just a simple average. So the 20 weekly moving average adds the last 20 weekly closes, divides it by 20. Simple, easy. All right, that's moving averages. There are multiple types of moving averages. There's going to be a simple moving average like we talked about. There's also exponential moving averages. The exponential moving averages are going to be a bit more reactive to price. And EMAs are what I like to do or like to use when I'm short-term trend following. So for example, for a name like, if I go into this study here, let's do this one simple. These are going to be the 10 and 20 EMAs. Basically, this is just a short-term trend following strategy. When these EMAs are positive, meaning the 10 is over the 20 and we get this nice green cloud, generally speaking, you should be looking for opportunities to get long. And when these EMAs are in a negative trend with the 10 EMA below the 20, generally speaking, you should either stay cash and wait for new opportunities to get long or be short, right? So that's how I trade the EMAs. Again, those are just an indication of short-term trend and kind of can help you hedge your portfolio on downtrends or take profits when a downtrend is, potentially imminent, that sort of thing. The last type of moving averages are going to be displaced moving averages. There is more than just that, but the displaced moving averages are kind of funky. Basically, they're like simple moving averages, but they're just offset or displaced. So I'll just show you a quick example of that just to cover it. So let's toss on our simple moving averages and we'll change our 20. We'll add a displaced. I think I just need to do this simple. So you can kind of see how this displaced moving average works. This is a really funky kind of idea. I don't really know why you would do this, but this is when it's displaced negatively. So you can see these moving averages are basically the exact same. The red one is just the yellow one shifted to the left. I think you could displace it to the right as well. Let me see if you could do that. I think so. Yeah, so you can displace it to the right as well. Again, really not sure why exactly you'd want to do that, but you could, I guess, if you want. So that's the displaced moving average. Everybody cool on that? Those are moving averages. A lot to cover from moving averages for sure. And again, we'll talk a little bit more about using the moving averages in our trading strategy in future lectures. But for now, the idea is just to get you introduced into what they are, kind of how they work, that sort of thing. Cool. All right, let's keep going. So the next one is going to be the Bollinger Bands. Bollinger Bands are also a nice way to kind of monitor potential overextensions in either direction. The really interesting piece about Bollinger Bands is this middle line here is the 20 simple moving average. The top and bottom lines are going to be +2 and -2 standard deviations of that midline. And bringing you back to kind of your high school or college statistics classes, anything that is basically all data, or let me rephrase, 95% of all data in a set should fit within 2 standard deviations of the mean. In this specific scenario, the mean is going to be this blue line, and 2 standard deviations of that mean is going to be between the red and purple line. So as a result, we should expect basically 95% of all price action closes to be between these 2 lines, the red and purple, or pink, or whatever it is. And you can kind of see, once we start to get pretty extended outside of these bands, very commonly there's some kind of reversal reasonably soon after. It's not always the same day, it's not always the next day either, but once we start to get extended outside of these bands, you really got to start preparing for a potential reversal. So just looking through this example alone, right here, we get extended outside the bands, immediate reversal the next day. Here, extended outside the bands, immediate reversal. Here, we couldn't even close outside the bands. Here, closed on the bands, immediate reversal. Here, immediate reversal. Here, stalled out a little bit, then reversed. Big gap below, basically immediate reversal. Here, use the bands as support. Long story short, these Bollinger Bands are always going to be some form of support and resistance. The other thing to kind of note is the expansion and contraction of these bands. So as the bands start to contract, that basically means volatility is decreasing. And once you see those bands begin to expand, you can think of it in the same way as you may be thinking of the TTM squeeze, which is the contraction of the bands represents price squeezing or consolidating, and the expansion of the bands represents price trending or moving in a direction. So anyway, that's the basics of the Bollinger Bands. So Bollinger Bands, in my opinion, are really, really nice. Oh, I forgot I had this lesson on standard deviations. Yes, this is basically what I said before, where +2 standard deviations and -2 standard deviations is about 95% of all the data in a set. And outside of two standard deviations is very low probability, and outside of 3 is even less. So if we pull up the study set that I had going on earlier, this is going to show us the 2nd and 3rd standard deviation Bollinger Bands. And if we look at this on the daily, the outside are going to be the 3rd standard deviation. We've made it out these 3 standard deviation one time. That was the dead bottom. Here, dead bottom. So fundamentally, these Bollinger Bands act as very, very strong support resistance levels. I mean, you can see this all over the place. NVIDIA hit that 3rd band, immediately rejected here, immediately rejected here. Once you see price moving into these bands, you gotta be very cautious about thinking that price is going to continue in that same direction. You see it basically all the time. So gotta be very cautious about trying to get long when something's super extended into the bands and also super extended to the downside. Cool. I think this might be the last moving indicator, which is the VWAP, which stands for volume weighted average price. Basically what this does is it performs a calculation with volume. So it takes into account both volume and price. And it basically plots an average line. And what you'll notice is as the market opens, this line becomes more volatile. And as the market kind of moves throughout the day, it starts to move a little bit less. And that's basically because there's less volume kind of coming through in the latter half of the day. So let me pull up volume really quick. I think I have a review up. Got that somewhere. Boom. And let's look at that for the S&P today. So you kind of see how the VWAP works, right? At the beginning of the day, the VWAP's a bit more volatile because we have more volume typically at the beginning of the day. And then as the day kind of slows down and volume drops off, that VWAP becomes much less volatile. And this can be a really nice area of support and resistance throughout the day. You can see today, it worked real nice as the low of the day in the morning. Not perfectly throughout midday, a little bit more choppy around the VWAP. So it's not always perfect, just like any indicator, but just kind of back testing this a little bit more. Decent level of support here. Here, we basically just chopped around the VWAP all day, so we really didn't do anything special there. So again, just like any indicator, not always perfect, but some days it's got some really nice performance. Here, basically ends up being the dead bottom at both higher lows throughout the day, so really nice moves there. So the volume weighted average price is interesting. It's got some history to it as well. It's actually been around for a very long time, which is why it still kind of holds some significance to this day. Basically, in the past, when there wasn't computerized trading or brokerages, you used to be able to call your broker and basically place a buy at VWAP. So that was typically regarded as kind of a fair price for the day. So you could go with your broker and just say, I want to buy at VWAP, whatever the VWAP is. Again, generally that was regarded as kind of a good, fair price for the day. So in the past, ended up being a support level for that reason. Not so sure it continues to be a support level for the same reason. And maybe it's just something that more people are paying attention to, but that's the VWAP. Cool. All right, let's see what else we have here. Okay, yeah, so similar to just all of our other moving indicators, you really want to look for bounces, rejections, or breakout of VWAP as support and resistance. So it's just going to behave like any other support and resistance line, like our moving averages, like our B bands, they all basically react the same way. All right, I'm going to skip this question because I know we're kind of moving quickly. We talked about some study sets. Before I kind of continue to wrap this one up, I know we have that one question from Skylar that we'll get to. Any other comments or questions with indicators? I think fundamentally indicators is a reasonably simple concept. You'll have to definitely work with them just like anything to kind of get used to how they behave. And then in terms of putting them together and starting to use them to take trades, that is definitely something that we will get to. We just don't really have time to in this class, and we'll start to be combining all these ideas in the latter half of our lecture series. So starting in the next couple of weeks and months, we'll definitely get into more of those ideas. Yeah, Carlos, for sure can talk about that. I just like maybe a little bit more clarity on what specifically you want me to talk about related to stop losses, like how to set them, what they are, why to use them, anything like that maybe you could help me out with. Cool. All right, Scholars. So a couple minutes to reiterate on reading volume and how to react. So just as a kind of a preface, any explanation I give now is going to be much more abbreviated than what I provided in the last lecture. So if you want to see kind of the full lecture, it's recorded. So I'll highly recommend you going to take a look on that. I think it's posted on the WAP page for free. So you'll just have to get on our free WAP and then you can get all the recordings for this. But basically, the price action and volume class, what we really covered, some of the more fundamental principles is that volume confirms moves in price. So without a significant corresponding move in volume, we shouldn't really trust significant moves in price. So some things that you can look for when performing volume price analysis is you can look for discrepancies between volume and price. So if we get a big move in price and a small kind of below average volume bar, that would be a discrepancy, right? That would be maybe a potential red flag to not be super excited to hop in and chase that move higher or lower, whatever it might be. A couple other things that we talked about in that lecture was we talked about kind of the accumulation and distribution cycle, which is something that you can monitor via volume price analysis. And I think one of the more kind of potent examples that we talked about were some of those small cap winners over 2024. So we reviewed charts like Robinhood or Hood, where we took a look at kind of the long-term, very clear accumulation volume over this wider basing period. Oh, you can see it's all still in the chart here. So you can see something like Hood went through this really kind of significant basing period, and basically every single above average volume bar ended up being green, meaning that as price was kind of basing out here, buyers really took significant positions over that 2 to 3 year period. And even once we came back down and retested that same kind of base high, we got a significant influx in buyers as well at that time. So that's basically the 1-minute summary of the volume price analysis class. I kind of started with the description of the fundamentals and kind of the result that you could expect from starting to employ volume price analysis is being able to really identify and have some conviction in trading bases like this. Yeah, fibs, Akash, we could definitely cover for sure. Probably not today, but yeah, it's definitely something that we'll pick up probably later in the course series. I think we talked a little bit about it in support and resistance, if I'm not mistaken. But if you feel like there's more detail that we need to cover, we can definitely do that. Cool. All right. Yeah, so stop losses, how to set them and how to react to them with a mental stop. So that's kind of two different questions. How to set stop losses. Uh, I won't explain how to set them for your specific brokerage because I don't know what brokerage you're trading on and it's going to be different for every platform. But generally speaking, a stop loss should be set where you think your trade is invalidated. So let's say, for example, you have a simple trade idea, it's Robinhood, and you're trading, maybe the breakout over this swing high, right? And let's say, for example, maybe you got long right here because you said, okay, we're breaking out over the swing high and we close back below this swing high right here. This may be a reason to stop out, right? Your whole thesis was looking for a break above the swing high and we just closed back below that swing high. So you should probably be stopped out as a result of that because now the core piece of your trade idea is invalidated, right? However, if that really is truly the core piece of your trade idea, and we start closing above that same level again on the weekly or daily timeframes, well, you should probably get back in too. So your stop loss shouldn't necessarily mean that you're never going to touch a trade again, but rather it's when whatever thesis or reason that you're in a trade or kind of core set of reasons are now invalid. Another kind of example of when you might want to stop out on a trade is, let's say, for example, you were long on the S&P. Again, I'm giving very simple trade ideas here, but let's say you're long on the S&P because the 10 and 20 EMAs were trending positively, right? So you got long on the S&P here. Once the 10 and 20 EMAs flip positive, here is probably when you should sell, right? Once those 10 and 20 EMAs flip negative, you should no longer be in that trade. If that's the core reason that you're long, you should probably be out once those EMAs flip negative. And very similarly, once they flip positive again, you should be damn sure to get back in that same trade. And that's kind of the difficult part about stop losses is, if it's sometimes if you're really trading whatever system that you're dedicated to, sometimes you'll end up buying back higher than you stopped out, or sometimes you'll end up selling, you know, anyway, that's basically how I would set a stop loss. And in terms of reacting to them with a mental stop, for me, when I'm setting a mental stop, I have an alert. So let's say, for example, I'm short on the SPY and my stop loss is 605, since it's the only level I have on my chart. What I would do is set an alert basically above that 605. And once we start breaking above that level on the lower timeframes, I don't necessarily immediately stop out, right? Just because price is trading above that level, but I'm going to start to monitor price action more carefully, right? And I'm going to wait for a price action close above or below my stop in order to basically stop out. So, for example, if I was stopping out based on the hourly, I would want to wait until I got an hourly close above that level. But my alert would trigger me to start paying attention and say, okay, price is starting to trend over this level. You should probably be focused more closely on this trade now. Do I think it's worth holding on to a trade that's 20%? Yeah, I mean, I think minus 20% is a pretty reasonable loss to consider holding on, so long as your plan is still valid. I think where things start to get a little dicey is once you start to get into the minus 50% territory, you have to remember that the bigger your unrealized loss gets, the more the position needs to rebound in order for you to just break even. So keep in mind that if a position goes down 50%, it has to now double for you to just be even again. And you guys should know, if you're maybe actively trading or taking any trades, 100% trades don't come around, every single trade, right? And if they do for you, more power to you. But for the most part, you're not hitting 100%ers every single trade you take. Maybe more often it's going to look more like 20, 40, 60, maybe the rare 100%er. But it's not a common occurrence. And even more so, if you let something go down 80, 90%, all of a sudden you're in a situation where you need to hit 1,000%er. And at that point, you're really in a hole, right? You're basically not coming back from that. And I don't know how many of you guys have hit 1,000% trade, but I could probably count on two hands how many times that's happened to me. It's not a frequent occurrence. So if you let something go red on you more than 50%, either you should be sized to basically let that position go to zero because the probability is that it will at that point, or you made a big mistake, right? You really need to evaluate why you're still in that position emotionally. If you're just holding and hoping and praying that basically that position rebounds, or whatever reason you're in there, you really got to evaluate that because you really should never be in a position that's I'll say, without justification, or a plan, like if you plan to go down more than 50%, like you knew it was possible, like you're taking a lotto and you're like, yeah, I could lose it all. If you don't have that mindset going into the trade, in my opinion, it really, especially as a beginner trader, should never be read more than 50% on a single position. And that's as a beginner, right? Once you start to get a little bit more experience, you trade some things that are a bit more volatile. If you like that sort of thing, then maybe that's not so big of a deal. But, an SPX could go break even to minus 50% in a single tick in some cases. So I could understand that, but I don't think beginners should be trading that. I don't think most people should be trading that. Good questions. Very good question, Carlos. Yeah, you lost 1.3K from holding and closed on a minus 60%. Yeah, I mean, at least you close at minus 60%, right? You recognize that that's probably not coming back for you, and you probably shouldn't be in that position anymore. So more power to you for letting that at least kind of end and stop the bleeding at minus 60 rather than letting that cook all the way to minus 100%, because a lot of people do that, right? They hit minus 60% and they're like, oh, well, it's basically all gone anyway, so might as well just keep holding it. It's like, no, like that's a horrible mindset. Like, yeah, you have a problem on holding. Yeah, I mean, a lot of people do, right? It's a thing in humans' mindsets, right? We don't want to be wrong, right? I mean, I can't name a single person in the world who's like, yep, I'd love to be wrong, everything I do and say, right? We don't want to be wrong. And the problem is when we are wrong, we have a lot of trouble accepting that, especially when it comes to situations where money is involved, right? We, maybe spend a time making a trade plan, or maybe we didn't. We take a trade and we think for whatever reason we're right. We're going to look for reasons to basically continue to hold that position, and we're going to kind of cope with that loss as it's already happening. So some reasons that you might catch yourself feeling when you're coping for a loss is hoping it's going to go back up, right? You have no justification for why a stock price may increase anymore. You're just hoping, oh, I hope it goes up, hope it increases, hope Trump pumps the market, hope Powell pumps the market. It's like, you sound like an idiot. You have no idea what you're doing. You should probably cut. Or just praying that a stock's going to go up or whatever. It's like, okay, unfortunately, that probably means that you're in a really bad spot financially based on whatever position that you put yourself in. So yeah, if you find yourself holding and hoping for a position, you should probably immediately cut. But ultimately, right, I wish it actually worked like this, but you should never enter a position if you don't know where you're going to stop out. And River says this perfectly, right? The three most important things, or I should say the priorities of levels to be paying attention to or setting when you're entering a trade are your entry, right? Entry's number one. You want to be getting good entries. And the second thing is your stop, right? You need to know where you're getting in and where you're going to say, I'm wrong, right? Because if you don't have that, you're doing yourself a disservice. You might as well just stop trading because you're not doing it right, right? You need to know where you're going to say, I am wrong. If you can't enter, if I basically audited every single one of your portfolios and I asked you about every single trade, you should be able to tell me where you're going to take profit and where you're going to cut it. And if you can't tell me that, you are fundamentally trading incorrectly. Like there's no way around it. No matter how you're trading, whether you're looking at level twos or, whether you're trading on fundamentals, you should have a stop. You should have some kind of level or some kind of quantitative piece of information that will dictate to you when you are wrong, when it is time to stop. And it doesn't matter what type of trader you are. It can even be fundamental, right? It could be, okay, I'm getting in this quarter based on, valuation, but if they have one more quarter of losses or they miss guidance one more quarter, I'm going to stop, right? That could be a valid stop. It could be a break over a level. It could be a change in trend. It could be a flip in the order of moving averages, right? The moving averages could flip to a negative trend. So all those are valid ways to stop out. Another thing that sometimes I'll advertise to beginners, and I think this is what JT is mentioning, is that, as a beginner, you could say you have a fixed stop loss. It could be minus 20 or 30%. That can work as a beginner, but what I want to know is that typically isn't the most effective way to stop out, only because it's not really based on price, right? It's just based on kind of an arbitrary value. So unless you're defining your trades in a way where minus 20% always ends up being, where you would logically stop out based on the chart, that probably wouldn't work, long term. But maybe in JT's case it does, and it works for him, right? So there's no right system necessarily for defining a stop, or no one way to do it for everybody. But fundamentally, if I look through every one of your portfolios, again, and you couldn't tell me a stop loss for every single one of your trades, you're just wrong. Like, you are not trading correctly. You are not practicing good habits at all. Point blank period. I would say worse things, but I'm not gonna, because I know we're all learning here, so it's okay. But from here on out, every position should have a stop loss. You should be able to look at your portfolio and tell me where you're going to cut it. That's the only thing that matters, right? Risk always should be mitigated before you start thinking about reward or profits, how much money you're going to make. Yeah, Carlos, you're at 70% win rate and you're right on the year. Big losses. Yeah, I mean, it's super common, right? If you're not managing the size of your losses, you could have a 90% win rate and be completely right on the year. Because if you're letting your losses eat away at you, you're going to get wrecked, right? You're feeling the pain of that, Carlos. So as you continue to stick around through this series, we'll talk about more strategies for defining your trades and kind of putting all these lessons together to help you deal with that. The moving indicator that I have on the chart now is the 10 and 20 EMA. So it's an EMA cloud. Basically, it combines those two EMAs to plot this little cloud, the green and red cloud, to help me better understand what the actual trend is. I like it. It's nice. All right, everybody. Well, I appreciate you guys staying with me a little bit over time here. I will see you guys all in the next week. I can't remember what next week's supposed to be, but maybe we'll try and do something more fun for next week's lecture. So try and switch it up a little bit and renew everybody's interest in the 7th lecture of our beginner's course series. So with that, again, thank you guys so much for your time. Appreciate you guys all being here. Sorry about the little mic delays at the beginning. I don't know what the hell happened there, but yeah, appreciate you guys all very much. And I hope you have a great rest of your night. And I will see you all in the next one. Adios, everybody.